For a lot of people, cash is king, especially when interest rates are high. But going into 2024, will that still be the case? Let's find out. Today we have with us Murray Collis. Welcome, Murray. So, is cash still king in 2024?
The last 18 months have been a challenging period for fixed income as central banks globally hiked official rates in response to persistent inflation and tight labour markets. The US Fed funds rate was lifted from essentially zero at the start of 2022 to over 5%, the highest level we've seen since the 2008 global financial crisis. As a result, investors, for the first time in many years, could earn a reasonable return simply by holding cash on deposit. However, as we look forward to the coming year, we see the upward move in yields and the likelihood of Fed rate cuts as creating an opportunity for investors to reconsider their allocation to bonds. And there are two main reasons why. Firstly, the reset in valuations have created conditions to earn attractive income in bond portfolios, particularly in markets like Asia. If we take the investment grade component of the JP Asian Credit Index, investors can potentially achieve yields between 5.5% to 6%, which is compelling from a long-term perspective. Secondly, central bank rate hikes, which have been a headwind for bonds in the past 2 years, could become a more supportive factor in the coming year as inflation pressures continue to moderate. In fact, we expect the US economy will likely enter a recession in 2024 as the combined impact of rate hikes slows growth. Should the Fed pivot to rate cuts, the policy regime could become a tailwind for fixed income investors. Putting this together, we feel investors should consider factors like slowing growth and evolving central bank policies and how this will impact the relative value of cash over bonds in the coming year.
Judging from the U.S. Federal Reserve's comments after their final policy meeting of 2023, it seems like cash's reign as king may indeed be over. If investors wish to put their cash to work, which fixed income markets could potentially perform better in 2024, when considering the volatility and total return profile, and why?
We believe that fixed income is poised to post relatively strong performance in the coming year as global central banks transition to end their rate hiking cycle. In this environment, we see Asian bond markets being well placed to provide attractive income, coupled with the potential for capital gains should central banks eventually pivot to cut official rates. Within the region, we prefer high-quality investment-grade Asian dollar bonds and selected Asian local markets. From a credit viewpoint, we see opportunities within the investment-grade issuers, particularly BBB rated names, with yields between 5.5% and 6%, which are underpinned by stable fundamentals and strong technical demand. While from a country viewpoint, we like markets with strong structural growth stories, similar to those available in countries like Indonesia and India. Looking at India, for example, the country is benefiting from growth in services exports and strong domestic consumption. We see the upcoming inclusion of Indian government bonds in the JP indices as drawing additional interest from investors looking for attractive yields available in this local market. More broadly, we also see opportunities for investors who consider sustainability. The ESG-labeled bond market in Asia continues to grow, and we see demand from an expanding number of dedicated investors based in and outside the region.
Murray, tell us more about how investing in Asia may offer a buttress against the effects of a potential U.S. recession, and the benefits of incorporating Asian bonds in a retirement savings portfolio.
Fixed income, particularly higher quality bonds, are well placed to benefit from a slowing US economy and potentially a recession in the coming year. With central banks globally hiking rates over the past 2 years, we have seen a significant repricing of fixed income. As official rates rose, many investors took advantage of attractive short-end yields by holding more cash in their portfolios. However, with slowing growth and the risk of a US recession in 2024, we feel it's time for investors to prepare for eventual rate cuts by considering a higher allocation to bonds, particularly in markets like Asia. From a longer-term perspective, the Asian market or the Asian region can offer portfolios a unique collection of heterogeneous markets, including those supported by younger demographics, higher savings rates, and long-term consumption stories. While from a valuation perspective, bonds issued by investment-grade corporates and selected local sovereign markets can offer yields around 5.5% to 6%. Although we recognise spreads in Asian bonds have tightened recently, persistently low levels of new issuance coupled with high all-in yields continue to underpin demand in the market. What this means for investors is that Asia is well positioned to perform should the US economy slow down and enter recession, whilst offering relatively higher yields for retirement savings portfolios compared to similar rated developed market bonds.
Murray, thank you for your insights. With the era of interest rate hikes likely at an end, and a discussion on when to cut rates coming into view, fixed income is poised to benefit from this shift in central bank policy. It is important for investors to reconsider the implications of holding on to cash, rethink their asset allocation, and reevaluate the merits of investing in the dynamism of Asia. Thank you for watching.